welcome to the 23rd edition of LM's Weekly Wrap, our weekly program to cover all the events which have happened in the markets. It's been a very volatile week as far as the markets are concerned. We had a very solid start to the domestic markets in the absence of global cues, and thereafter with global cues coming into the picture, it's the picture has changed completely. It's been a very volatile picture. We've seen relentless selling by FIIs during the last 10 days, and this is actually the selling has accentuated or increased during the last two sessions. I think during the last two sessions there's been a selling of close to 4,000 crores in the cash market. So to explain more about the domestic factors as well as the market factors, with me is Jash. He'll be explaining all the developments to us, which will be followed by the sectoral update from my side. So welcome, Jash, and kindly brief us about the developments.
Thank you, sir. It's great to be back in front of you all. And today, as usual, I'm going to start with the Nifty, and then I'll go to global markets and domestic markets. I've been repeatedly saying that 18,000 levels is very important. It again broke yesterday, and today we are seeing close to about Nifty close to about 17,800 and 900. I think there is a lot of selling pressure from the FIIs, as Nirav sir rightly pointed. Let's understand why this is happening. Coming to the global, I would start with the global markets, especially the United States of America. Yesterday we had seen data of US jobs. It shows it's very strong. On the contrary, they are fearful of recession, inflation, and with the US jobs data being this strong, there is some kind of mismatch. Why is it? Basically, there was a lot of helicopter money infused in the market during COVID. So there is still money in the bank of the citizens, and hence we see an effect on the mortgages. But the credit spending is still quite high, and the wages levels are quite high. So that means the inflation is still intact, and we see strong inflation in USA. To control that, the Fed is still going to increase rates. They have already hinted in the Fed minutes, that they are going to increase rates in the coming months or quarters. So that is what instilled a 1.5% negative impact on the US markets, and that is the reason that FIIs have been selling in India. So this is a direct correlation of the whole global cues on the Indian market. Now, coming to recession, along with USA, UK and China are also poised for a recessionary scenario due to inflation, because they are heavily trying to control the interest rates. Even if you see Japan, which is such a liquid market, they have also gone into a YCC, yield curve control, where they are only buying 10-year Japanese bonds, the yen bonds. So looking at all of this, I think the world is there here to control inflation, and that is where the emerging markets are being impacted. Now coming to the future, what this is for India. So basically, India is also doing a rate hike to match up to the US and the other economies. As if the US rates are at 5.5%, India can't be at the same level. They have to be ahead, otherwise they will see more selling in India and going back to USA. So somewhere down the line, this year or this year end, the interest rate cycle is going to peak out, and that peak out will lead to the dollar index becoming more weaker, because the rates might be there itself, but the dollar strengthening will stop and it will start weakening. So that is the time we'll start seeing the FII money coming back into India. So and with the whole trade agreements and the manufacturing sector in India, we are poised for a very good growth. And the latest trade agreement between India and Australia, that is a beautiful agreement, and for that country, buying goods from India will be actually cheaper than any other country in the world. So such agreements are also being in works with UK, EU and other countries. With that, to control the inflation, the Indian government the RBI has started trading in rupee and ruble, and rupee and with the Saudi Arabian currency. So that is also helping us manage our inflation. I feel the RBI is doing a very good job managing our inflation, and we are definitely placed much better than the other countries in the world. And also, if coming back to the markets, if you are invested in the market and you're seeing that your portfolio is doing nothing and the markets are very volatile, it is going to remain that way for another 3 to 4 months or maybe 5 months. But this is the time to start accumulating in parts. I wouldn't say put all your money out together because we don't know what's going to happen tomorrow. But it's very attractive to keep investing in parts for the next 6 to 8 months, and then we are definitely waiting for a huge rally. Of course, that is if all the factors remain constant as we see right now. And with this, I would hand over to Nirav sir for the sectoral updates.
Yeah, thank you, Jash. So I think first of all, starting off with the global cues, as pointed out by Jash, I think Federal Reserve minutes were important, and they have clearly said that quantitative easing and quantitative tightening remains the prerogative of the Federal Reserve. So they will control the rates, they will control the rate at which
Correct.
the hikes will take place, and the primary intent is to tame the inflation.
That's right.
That's one factor which is very important. Second important factor is, despite we seeing strong economic data coming out of the US, the US Federal Reserve still wants to hike the rates.
Correct.
This essentially implies that even if there is a problem of unemployment due to higher interest rates, or the velocity with which the money is circulating slows down, we will at best see a mild recession in the US.
Correct.
So that's the view which is coming, because the economic data is very strong.
That's right.
We are likely to see strong jobs data too. So if there is a recession, I repeat, it is likely to be a mild recession. This is a view which has been shared by many experts, and I think how things pan out eventually we have to see. That is one factor. Coming to the sectoral outlook with respect
Sir, for the sectoral outlook, I would just like to add one point. That is the very important data that I would like to highlight. In December first week, the government of India bank balance was about 5 lakh crore, and they had not deployed any money. And coming in the Jan first second week, if we see the bank balance is about negative or close to zero, there's heavy investment by the government into the infrastructure space, and especially into railways. So that's where I want to add my point, as railways is our strong theme. So this is a very important point.
So yeah, I think that's one important factor to watch out for. That is the government spending. Starting off with the beginning of this week, we had strong auto sales numbers. But along with that, we had companies like Escorts, Mahindra and Mahindra come out with very strong commentary with respect to the rural economy. One is relating to the MSP, which is the minimum support price, a strong Rabi crop, and wheat and oilseeds are set for a bumper harvest. So the commentary from rural is looking pretty decent. But we have simultaneously also had the FADA data, which is the Federation of Automobile Dealers Association, and they have said that after a couple of months of adrenaline rush, we have the auto sector, the retail auto has gone into a lull. So that is one factor. Going forward, the auto sector remains very, very cautious. They remain very cautious on account of a couple of factors. One is the inflationary pressure, and the second is the stringent emission norms which are set to come. So that's the cautious outlook with respect to the auto sector. That's one. Second is the banking segment. We've seen very good updates coming in from the mid-tier banks, from the private sector banks, the quarterly updates. But I think yesterday the update which came from Bajaj Finance has disappointed the market. So we've seen FII selling accentuate in the likes of Bajaj Finance, Bajaj Finserv, and ICICI Bank in particular. We've seen Bajaj Finance lose about 10% in trade since yesterday. So I think this remains to be a cause of concern, because whenever the FII selling has accentuated, we've seen the Bajaj twins and we've seen the HDFC twins suffer particularly in the market. So that's another factor to watch out for. Capital goods, no major developments. I think the outlook remains fairly stable over there. FMCG is seeing some ray of hope, because we've seen quarterly updates coming in from Dabur today, and Marico and Godrej Consumer Products, and all these companies have reiterated one thing, that the urban demand remains fairly stable and rural is making an limping back towards normalcy. So the rural demand is also, which was largely muted, is trying to make a comeback. Pharma remains more or less the same. IT sector will be in the limelight. Today we saw the frontline stocks under tremendous pressure. We've seen TCS down about 3% in trade today. This is ahead of the quarterly results which are going to be announced on 9th of January. So that's something to watch out for. Metals remain under a lot of pressure. I reiterate our view that the bullish phase is over. As far as the bullish cycle is concerned, it's peaked in March 2022. We saw a fall in June. Now we are trying to make an attempt a pullback. But a super cycle will not be possible at this point in time. So we might just have some intermittent rallies here and there.
Especially with China, I don't think super cycle is possible because they're the biggest producer.
Yeah. So I think that kind of pretty much sums up the overall outlook for the market. Rest, I think defense continues to do well. Fertilizers continue to do well. Sugar continues to do well with raw sugar prices at 5-year high. And I think railways continues to do very well. So nothing much to reiterate over there on that front. And I think this week one sector which was the star sector is the tire sector. We had positive ATMA data, that is the Automotive Tire Manufacturers Association, positive data. We have seen a cool off in the natural rubber and the artificial rubber prices. That's a positive for the sector. And third, today we had a positive commentary from a leading industry player, that is Seattle. So I think there we've seen some good spark as far as the tire sector is concerned. Many things to discuss, but time constraints do not permit us. But do write back to us with your feedback on our program, and I think we'll have the closing comments from Jash.
Yeah. Thank you, sir. I'd like to add that please like, share, and subscribe, and download our app for all our research calls and trading bets. Thank you.
Thank you so much.